program, the event. Let me invite Mr. SandeepTandon, CEO of Quant Mutual Fund, and Vivek Karwa to welcome him with a bouquet.
SandeepTandon is the founder and chief investment officer of the Grant Group.
Thank you. I generally try to break a lot of myths, okay? And I will break one more myth today. So obviously part was about how you decode perception analytics. So let me break some myths, okay? And again, don't look from criticism perspective, look at from perspective what I have learned, okay? I have also grown in the same traditional manner. I'm trying to change myself and I have changed a bit. So I thought let me share the experience. Now, one important aspect is about earnings, okay? Everybody talks about earning in this country. Majority of the analysts forecast earnings, 3 years, 5 years, 10 years. Some people have a decadal perspective also, and some people have in century perspective also. But ultimately, all earning forecasts are based on assumptions, okay? Anything you do with assumption based on certain things you forecast. And if whatever reason those assumptions turn out to be wrong, you have positive or negative surprises. Both ways possible. Okay. Now let's understand how to address this problem. Okay. So when we talk about pricing in the market, what drive pricing is earnings and the multiple both. Okay. So you are talking about earning forecast, but nobody does anything related to multiple forecast. So multiple, whether it's PEV or price to sales, price to earning, price to book, or any EV, any parameter you look at, okay, ultimately it's a balancing number. So if any earnings, if 5% earning has increased and you want to increase the target as an analyst, you change the balancing number of P multiple. And that's the way your forecast changes, okay, upside or downside. That's the way I as an analyst, we always saying, forecasting P multiple is just is a balancing number, nothing more than that. Now, come back to the reality. Earnings we expect. Now, what we do, instead of talking about price to earnings, we take this concept to the perception analytics. Okay, and this is the whole title of today's presentation is about perception analytics. Okay, instead of price, we are bringing a perception. Now, that's very important to understand the perception aspect. Perception, both in absolute terms, perception as well as relative terms. Okay, we always talk about quant as a house. It's not about momentum trading, which a lot of people expect from us. We are momentum house. No, we are actually extreme inflection points. And let me explain to you this thesis first. When we talk about perception, let's go. When we talk about, let's go one step backward. We always say, what drive prices? We say demand supply drive prices. Okay. When we talk about what drive demand supply, is the perception drive demand supply. And what drive perception, then you can drill down into sentiments and as deep as possible. This is how mathematically we quantify that. So when we talk about perception analytics, is not a survey based method. Okay, like how exit polls can be, or any survey happen on the economic indicator, or any PMI numbers, anything which is theirs are largely survey based things. Okay. When we are talking about mathematically decoding perception, now let me give you a small example. How you look at earnings momentum, cash flow momentum, okay? How you look at the board aspect, okay? I'm talking about very, very subjectivity aspect, you know, where everything cannot be defined in a so objective manner, some amount of subjectivity. And even if you can quantify the subjectivity up to certain extent, then you can really understand how the perception analytics work. And that is something we have tried to build at Quant. Now, when we look, let me give you a small example. Let's talk about India for 2 minutes. Okay. Now, if I go back and take it 2 minutes more and explaining before we come to the perception aspect. Last 1 year, we all have been hearing from the best of the money managers, best of the analysts, and best of the strategists. Indian market is very expensive. Okay. It is most expensive market in the world. And that's the reason FIs are selling. And somehow retail investors have not understood, they will be trapped. Okay, that was a very intelligent answer. Last 1 year I have been hearing, but market never corrects. Okay, why? Because we are looking in one dimension. If you are purely looking at the valuation analytics, yes, I agree, valuations are relatively stretched. I'm not saying extraordinary, but they are relatively stretched. Not extraordinary in absolute terms. When you bring second dimension about liquidity, what was the liquidity in 2000? Because I'm giving example because people say market peaked out in 2000, then 2007, 8, and then January 2018. If I have to say back in last 25 years, these are the three important year where market peaked out. Okay. Now, valuation aspect, we say that forget Lehman for let's say dot-com bubble of 2000. Let's come back straight away 2007, 8. Yes, valuation was relatively stretched, and a lot of people give example. What happened in 2007, 8? What happened in 2018? We are somewhere similarly. We are there, and this similarly was there since 1 year now. Okay, but market has not corrected. So you bring the second dimension of liquidity. So what was the liquidity in 2000 versus today global liquidity? We are few hundred times, not even percentages. Okay. Now, what happened in Lehman crisis? Everybody know the QE started. All the central banks came together. That was the biggest moment in the history where all the central banks in cohesive manner pulled up the liquidity. Okay. And that's the way the QE journey started. And people remember Lehman event was the highest ever liquidity was pumped. It was true at that point of time. Today, global liquidity is few times of Lehman liquidity also. Okay. And then you further break this liquidity as a concept into good liquidity or bad liquidity, where you bring your productivity angle, efficiency angle, okay, and how it can be measured. That's a separate issue. Now bring the second dimension about perception, which I am coming to. What was the perception in 2007-8 for India versus today? We barely managed that Lehman crisis. Look at the currency, yields, every parameter collapsed. Today, perception for India is one of the best, okay, in the world. Absolute basis, we are very good. And relative basis, we are extraordinary. Extraordinary to US also, extraordinary to China, developed market. You leave some country like Vietnam, Philippines, or up to a small extent, Bangladesh is also doing very well in certain areas, okay. You leave Vietnam, let's say, for time being, or Indonesia for time being. Okay. So what was the perception? Very unique. Now I'm going to decode further on the India perception. Why we say this decade belongs to India and maybe half century belongs to India. I'm going to address entirely on the perception analytics. India perception, we are in that cusp of that inflection point I have been saying for a while, okay, where India perception has changed. Something big has changed. And a lot of people are not understood that. And best of the intelligent people are making mistake saying market has peaked out. We have seen multiple cycle. This is another cycle. Move out from the market. And that will be the biggest blunder if people make. Okay. And when I'm looking at not India in isolation, I always look at absolute and a relative both. Don't get into chart angle of RSI and all those things. Relative is a very deep concept because this whole universe works on theory of relativity. Even returns are relative. Okay. So relative phenomena is far more important to understand. If I have to talk about what is changing without getting into nitty-gritty of any specific events or numbers, the Indian macro, because this perception analytics come from, if I look at the country-specific numbers, obviously it's come from larger macro data. When you country-specific from macro, when it comes to company, okay, then 70% or 75% will be company-related perception, and one third can be sector-relative or the macro-relative. So when we talk about perception for India, the way we have analyzed these data is very interesting. Okay. If I have to talk about perception versus our perception versus emerging market, yes, we are on the higher side. Okay. When I look at this perception for comparative to US and developed market, we are in very infancy stages. Okay. So this perception, if I have to really quantify, if I go on some numbers and able to quantify mathematically how long, so we believe this perception has potential to peak out by 2047 when India demographic cycle peak outs. Okay, that horizon we are talking about. Now in this period, if you believe market has peaked out and I'm going to pull out money, I'm going to relax for a few months and I'll get opportunity, I personally feel that is a very stupid strategy and a lot of people have paid huge price in last 1 year. Whoever has sold has moved out. They are now unable to re-enter market because it's a psychological problem. You sold at X price, now it's 30% higher, 40% higher, some stocks are 80% higher. Okay, I'm index itself 20-30% higher, then you can imagine what a stock's about. So India perception, a very, very unique situation. This is something like when people talk about how Japan has grown for 30 years, how US cycle lasted for 30-40 years. I think we are in that situation. It can last for longer, and I'm talking about, if I take it this analysis to the next level, okay, where we start comparing DM versus EM, and if I talk about Asia-centric emerging market, that is the area where maximum opportunities will be there. If I talk about Asia-centric emerging market, it is the perception is very, very low. Okay, and it can be measured through liquidity, it can be measured through how the risk appetite changes. Many macro data can go into it. But what is very important from a conclusion point of view for you to understand, India is at cusp of that cycle, okay, where you have only seen first 3-4 years of that bull run, okay, and this cycle or this has more legs, and it can be very meaningful move which we are talking about, okay, and that's one of the reason why as a quant, as a house, we talk about dynamic style of money management, okay, because we live in a very dynamic world. Our money management style, which is very static, that strategy has failed globally. Why we respect US as a country, they're evolving, they adopt many things very quickly, okay, and we admire how US as a country and US as a money manager are so advanced, they're willing to adapt new things, they're willing to learn, where emerging market and India particularly, we are still living in the old days. The traditional style of money management, that phase is over. Globally it is over, okay, and I'm looking more from a longer term perspective. I'm talking about how behavior data points will drive your thought process, okay. You should not be driven by just earnings. Okay, if you are just looking at pure earnings, then you will not get answer. Best of the money manager has failed this time because they were just looking at the earnings power. What is my, now if you look at earnings power, then you don't have answers. When you look at cumulative, that's the reason when we talk about our VLRT framework, we bring valuation analytics, risk appetite, as well as liquidity analytics. So valuation, risk appetite, and liquidity analytics all put together becomes of timing as a function. So timing is not a trading tool. Timing is the analytic. Timing is a risk material. Timing is the analytics. So timing analytics is a function of risk appetite, liquidity analytics, as well as valuation analytics. If you can understand the larger thesis, then we are talking about half century belongs to us and this decade belongs to us. That level of bullishness, but then let's not confuse much larger picture for 3 months move or 3 years view or 2 months move, okay. So we have to look at these data point in separation, okay. So when we talk about quant as a money manager, we always say that we manage money like a treasury management. We have a decadal view, medium term view, long term view, short term views, okay. How you do all these sort of analytics, okay, when you combine whole thesis that in totality you should. So your portfolio should have combination of long-term risk, medium-term, long duration, medium duration, short duration product, as well as high risk, low risk, and medium risk in your portfolio. And this is the entire way we position our bouquet. Every investor has short-term, medium-term, and long-term needs. You cannot just buy and saying everything is long-term in life. Okay, you have your vacations also. Every year you want to go vacation. You can't say I will go to save first 20 years, then I'll go for vacation. House you can do it because house is extraordinary cost. You can't go, I will not relish today, I have to wait for some time, I wait for 1 quarter or 1 year saving, then I'll go for nice restaurant, okay. So when you design your portfolio, keeping in mind short-term, medium-term and long-term needs, along with your risk profiling, you will be a winner. Why I'm talking about or harping about these events? Because we feel it's a very unique opportunity. Yes, you can switch. If you think, if you're, let's say, in thematic theme and you say some cycle has peaked out, you can switch. Maybe in today's context, a multi-asset fund will do very well. If you're a pure equity guy, a flexi cap as a theme will do very well. Like how we talked about right from September 2021, value as a thesis. We said it's a decadal opportunity. Now we are not saying value is a 3-decade opportunity. Okay, this is the current decade opportunity, but India is a 3-decade opportunity. If I have to add 2 more points about perception related things, how we look at India right now. The way we look at these data points is giving me that sense that maybe from mid of 2025, no, don't get into specific dates and year, okay, the trajectory is more important. By mid of 2025 and going forward, we expect India as an asset class will emerge. Today, why we suffer, our FPI money is not coming to India, because we are part of emerging market buckets. Overall emerging markets are not performing, and hence Indian pie is also on the lower side. Rather, actually Indian weightage has still increased the MSCI EM basket, but in absolute terms it's shrinking. Okay, once India become as a separate asset class, okay, and when that phenomena will happen, when US start underperforming or US perception peaks out, which we believe it will happen maybe in a year's time or so, okay, maybe appropriate time we'll talk about in length. But if that happens and a 10% of money from US shift to India or Asia-centric emerging market, there will be tsunami out here, okay? Not tsunami from a one-day perspective, from a longer-term perspective. So that sort of perspective you have, because ultimately you look at, we always talk about energy. It never dies, changes from hydro, let's say kinetic to potential energy or hydro to back. But similarly, money shift from one asset class to other. Money shift from high risk to low risk environment, okay? And that is something what we are saying, that India risk appetite versus US versus developed market is significantly lower. But what is very important is rising. It's not spiking, it's rising. And rising risk appetite and much lower relative to global opportunities, which means if liquidity shifts, there will be a great opportunity. With that background, let me show you a few things. It will work here? Okay, perfect. Just to share, we are now nearly 93,000 crores of asset under management, okay? And what is very important for us, we have nearly 80 lakhs folios, investor folio, or more than 80 lakh. That is a real achievement for us, and we are very grateful to people like you who have supported us a lot, okay? Because we run a very asset-light model. No branches, no salespeople, okay? And we are dependent completely on you. So special thanks for that. Now, purely from a performance point of view, we take up a very sizable industry incremental flow. Last month, this month only rather, one of the research houses had talked about, we have not calculated ourselves that small cap index has grown, and we were actually 60% of the industry. The 60% alone quant small cap has gathered, which is a very sizable number and something which is very difficult to digest for us also, that one single mutual fund can get this levels of flow. Okay, so I briefly talked about perception aspect, and this is a very important thing. Let me look at some example. Okay, so if you now look at from the perception point of view or data which you look at, we are trying to show out here. Look at our performance as of yesterday from the March low. We always take March 24th low because it's a COVID hit, and that's the time we implemented our VLRT. And every data point is related to that point. And very interesting data, if you look at from focus fund, we have or old scheme, these are the new schemes. So somewhere close to 350 to 900% point-to-point returns we have given, which is very meaningful. If you look at versus Nifty benchmark, we have given somewhere from 150% to 700% outperformance. And that is something which is great. But what gives us satisfaction is about our risk-adjusted measures. Whether you talk about Sharpe, Sortino, Jensen Alpha, when people think we are risky house, we are actually very conservative out. Our risk-adjusted returns are highest in the industry and is highest in all the categories which we operate. And that's the example how success of dynamic style of money management we talk about, we have demonstrated, and we want people like you to change first so that you can change the mindset of investor who are still stuck with traditional, and the gaps is increasing significantly. And that is something which we are very proud of, that we are the first AMC who brought the concept of dynamic style of money management, and it has played. Other important data points is also want to explain. Two things we talk about. Lot of people think we are born in bull market. Okay. So size is something, and we were born in bull market, so we have done extremely well. So let me give you some perspective. Okay. If you really look at out here, 2020 benchmark versus our comparison, returns are extraordinary, so is 2022. But look at 22. Very sizable industry returns were very, majority of the schemes have delivered negative return in calendar year 2022. Okay. And this was a tough year. Now, Quant as a house, if you look at all our older schemes, we delivered between 10% to, we deliver between 10% to 28% return. Okay. So it's not fair to assume that we were born in bull market only. In the difficult year, we have done extremely well. Let me also give you some more example. Yeah. Okay. Is better? Okay, thanks for doing that. Okay. Now, let's look at one more example I want to talk about. Okay. Now, very important slide I am trying to showcase out here. Okay. Okay. 1 minute. Okay. Yeah, one more slide when we're talking about the bull market thesis. We launched our BFSI fund in June 2023. And first 6 months, either BFSI index, depending on the which index you're looking at, either it was plus 2% or minus 2%. Okay. Assuming it is plus 2% also. Quant BFSI in the first 6 months delivered 64% return when the industry benchmark was flat to negative. Okay. So, and it has actually given higher return than small cap as well as Nifty itself. So that's the way how the portfolio construct work. It's not fair to assume that when cycle is against you, your scheme will underperform. If your portfolio construct is good, and this is one lot of people have raised questions about us when we're launching multiple schemes. You will say your team is very limited. Okay, how you will grow? Because the way we manage our money is same team was managing 27 crores. And same team manages 93,000 crores. So very, very scalable the way we do it. Okay. Now, very interesting aspect. Any scheme you look at out here, in whatever timeline, if you look at out here 1 month, 2 months, and 6 months, or since inception you analyze, look at the DAF. What is the gaps we generated? Okay, business cycle, even BFSI, the healthcare, manufacturing. This is a very tech. When you look at the tech, we have delivered annualized return in what form since our launch date of 11 September, nearly 41% versus benchmark of 21. This is what meaningful is that when tech is doing very well, our tech fund has doing actually quite well. And this is the way how all our thematic funds have done extremely well. Okay, now I'll go to the last slide for you. Okay, this is a very interesting data. How, as a house, we are to showcase our capability in managing known and unknown risk. So if you recollect January 2023, Adani episode, Hindenburg episode happened. Okay, we were a very large holding. Okay, maybe after fall also we were holding around 6% or somewhere in between around end of January. We were around 6% of Adani Group. We have Adani Ports and Gujarat Ambuja. At that time, a lot of people criticized. Today, best of the analysts have upgraded to, and targets are 3 times whatever we are holding. That's a secondary issue. Now, how we manage that risk which I am coming from. So Adani fell, the impact was lower to us. The real damage was PSUs. Okay, the collateral damage happened in PSUs and we were holding 20-25% of PSU in our fund. Now 15 months later or 18 months later, if you go back and analyze, then you realize we were 15 months earlier in taking the PSU calls. Okay, and that's the difference. If we could have kept the exposure portfolio as it is, the outperformance will be 30-40% higher than what you are seeing today. So that is the way, but when it comes to risk, we manage. So let's take example, we manage that risk. March 2023, we were the worst performing fund in all the categories. Come July 2023, second quarter, we were in the last quartile, not the last, but in the last quartile. Come January 2024, we were number 1 in across all the schemes, okay, all the categories. Okay, this is what we are saying from the last position of 49 AMC or 50 AMC. If you take it, leave the newer ones. Okay. Out of 50 AMC, we were the last, and we came back #1 position. That's the way how you manage your risk. That's very important. If it is a risk on, you can play on front foot. What we took a call in September, October, it's a risk on call, and we made a monthly call we talked about, and we got benefit. But in risk off period, you have to lie low, just preserve the capital. If you try to venture too much, that you have lost some opportunity, and now you want to play on front foot, the probability that you can be clean bowled. And that's the way we always talk about. We are in the business of risk management. Returns are byproduct. Don't focus on returns. And that plays a bigger role. Now, if you look at, I will take 2 more minutes. Now, if you look at any category, 3 months what we have delivered, 6 months, 3 months, 1 year, you can give fairly good performance if you look at a longer term versus benchmark. I think we have done an extraordinary good job, an absolute thing, but I always said that risk-adjusted returns is very important. Just from a concluding point of view, perception analytics. Keep in mind, something has changed, and you have to change from a longer-term perspective. Thank you very much.
So Sandeep, of course, your performance is known to all of us. What we would also hope for is a branch in Chennai, so we can be serviced better. So that's a basic expectation, sir. Okay, so I'll invite the biggest fan of Quant, Mr. Padmanabhan, to come and honor Mr. Sandeep.